In weeks such as these, you're sitting in one of three camps. You're either chasing the rally, covering your shorts, or rolling in the dough. And if you've been following this channel, the cookie dough has never been sweeter. With the S&P 500 capping off a perfect week, erasing 6 weeks worth of losses in just 5 sessions, we now ask the question, have markets come too far too quickly? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell, let's get into it. And what a crazy day. Energy got sold, so too did defensives. Apple weighed on tech, but it was a broad-based rally everywhere. Looking at sectors, the worst performing sector was energy, red on the day. Real estate continues to see huge amounts of buying, and all of this resulted in the S&P 500 closing out a perfect week, up nearly 5%. And I have some data for you guys. The S&P 500 just had its first perfect week since November 2021. After 1 week, we normally have an average return of about 0.25%, and normally it's about 60%, just under 60% positive. Just under 60% positive. After 2 weeks, we normally get a 0.46, about 0.5% return. And this happens just under 70% of the time. But let's go into the 3-month, 6-month, and 12-month return. After a perfect week, on average, 89% of the time, after 12 months, you will have about 15% return. After 6 months, you've returned about 6.22%, 78% of the time. So having a perfect week is normally very, very bullish. And this is from 1990 to 2023. And all of this, guys, was on the back of yields. The entire yield curve moved lower. Yields fell. It had biggest one-day drop since March. You can see right here, we did have a sharp intraday pullback, but this is what happened to bond prices. Bond prices absolutely shot up on the open. It did get sold off, but overall, a very, very bullish day for bond prices. And investors are scrambling to lock in rates because the data coming in shows the economy is cooling off. We got the non-farm payrolls report came in a lot softer than expected. Hourly year-on-year wages was better, but month-on-month was worse. And you could definitely see that the data coming in right now shows the economy is softening, the economy is weakening. And this is going to really help inflation and affect rates. And we got the latest Fed Fund futures data and it has changed. So just yesterday, we were predicting the first rate cut to come in June. We were expecting about 3 rate cuts in 2024. Now we're expecting the first rate cut in May, and we're actually expecting 4 rate cuts. So the market is really looking at this saying the economy is slowing a lot quicker than we thought. The data is lagging. It's now coming in and we need more rate cuts, Fed. You've broken the economy too much. We're going to have more rate cuts. The housing market, the jobs market, the labor market, all of that. We're going to need to compensate. But this is really, really good news for stocks. And here's the proof. This is the Fed fund rate after they've had their final hike. So when the fund rate was at their upper band, in the short term, it's not that positive, but in the long term, it normally is. And after 12 months of the last rate hike, you normally have an average return in the S&P 500 of about 14%, a 6-month return of about 5.2%. And this occurs about 60% of the time for 6 months and 80% of the time for 12 months. So very, very positive stats here. And this is why I was so bullish last week when everybody was bearish. The sentiment on Twitter was crazy. I said rates have peaked for the interim, and we discussed that at length, as well as some positive breadth divergences we were seeing in the market. We were looking at stuff such as the 20-day moving average, and we said that we saw this divergence right here. We saw divergences in the RSI, the MACD. We also saw that smart money was buying the dip, and earnings came in significantly better than expected. I think 71% of companies beat earnings in the S&P 500, and this is why it's so important to look at the data and not necessarily sentiment, and take sentiment with a grain of salt. And have a look at the sentiment data, the newest sentiment data. We spoke about this yesterday. 50% of members were bearish for the next 6 months, 43% the week before, and it just goes to show that people become the most bearish at the lows. Goldman Sachs said in 1987, the AAI bull-bear ratio has been less than 0.5 102 times, about 5.39% of the time. The current reading is 0.48. And This is the bull bear spread right here. And you can see that the average return when the reading was less than 5, the average S&P 500 return in the next month was 2.6%, 74% of the time. In 3 months, 4.3% of the time, and in 6 months, 8.3% of the time. And that normally has a hit rate of about 75% across 1 month, 3 month, and 6 month. And this is the bull bear spread. And pretty much if it's less than 1, there's more bears. If it's more than 1, there's more bulls. And you can see the data right here, guys. After 1 month, 3 month, 6 month, 12 month, when the survey gets to less than 0.5, people are very, very bearish. You normally have your greatest excess returns. So this indicator right here, the AAI bull bear indicator, this indicator right here, this is actually a contrarian indicator. When people are bearish, you need to be bullish. Be fearful when others are greedy. I know I say that a lot, but Warren Buffett's my favorite investor. We have some very, very bullish options activity right here. Some very unusual options activity, stuff we don't ever see. Russell, IWM, right? Look at the puts to calls, about the same. Look at the SPY, more calls to puts. So all of these put buyers are now put sellers. All of these call sellers are now call buyers. The QQQ, more calls, more puts. A lot of people have suddenly turned bullish. I swear, the sentiment on Twitter last week was wild. People were so bearish, calling for 2022 lows. Look at the Friday volume, 51 million contracts traded, 25% more than usual, absolutely wild, with 57% calls, 43% puts. But moving on to seasonality. What happens when October is lower? So this is the S&P 500 performance when we've had a negative October, but we're still positive year to date. And this is the returns. 88% of the time, we normally return 4.8% in the final 2 months of the year and 2.4% in November. And very, very positive statistics you can see. So October, we normally hit a low in October, and November and December is the Santa rally. But what can we expect for next week? So this is where we are right now. Okay, when we open Monday, we're going to be here, and we can expect from the 6th all the way to the 10th, next week's trading week, we could expect sort of just very range bound. The market is fairly overbought, and we do just need a bit of range boundness just to reset everything. Then we can move higher into November, into December. And our game plan was to buy in the 4150 to 412 area, looking for longs, looking for the Santa rally. And let's hop into the charts and have a look at this. So you see this key support zone? This is where I said we're going to be buying, and we did buy in this area. We did buy into this area, but we also made a lot of purchases right here. And look at what has happened since. We've had 5 green days in a row, nearly coming close to the highs we saw in October. But let's break it down. Let's go into the 3-month chart. And we said that we were looking at key levels. On Monday, the level we were looking at was this level right here, all the way up to 4200. We reached that level, used the resistance, made it into support. Then we said 4250 was next, and then 4290, the 4300 level. We said that when we get to this 4290 area, we're going to absolutely move quickly into the next area, which is 4340, because this area had a very low volume. It was a low volume area, and the next area of big volume was sort of this range right here. When we blasted through this range, we're now going to consolidate at the 4380 area. Into next week, if we could stay above the 4340 area, the 4340 to 4350 area, if we could stay above this, it's looking very, very positive for the last 2 weeks of November into max pain into December. Next week, the key is to stay above 4340, and possibly, if we want to look higher, to take out the highs into 4425. That is the game plan. So stay above 4340, take out the highs at 4225. Let's get into some dark pools. So there wasn't much in the way of dark pools. These are the charts right here. So we had the Russell, big trades came in the end of day. Same with the Qs, huge trades all here. Crazy. And then the S&P 500, we did have a phantom trade right here. This trade could have taken place here, or 2 brokers could have made a deal at 431. And then the equal weight, there was no trades at the end of the day, but we did see trades sort of at the low at the start of the session right here, but not much in the way of dark pools. But I do have something more interesting for you guys. This is the Zwick breadth thrust. Okay, this signal was triggered, and pretty much what it is stocks moving from oversold to overbought in less than 2 weeks. And this has occurred everywhere where it's green, and we've just triggered right there. And this is the returns after the ZBT is triggered. In 12 months, we normally get an average return of 23%, 100% win rate. And the same is true for 6 months, and 76% of the time after 3 months, the market is higher. And look at this return, 4.8% return 94% of the time. It triggered on the 31st of the 3rd in March, and look at the return we've had since. 0.2% after 1 month in March, and 8.4% 3 months since, and 4.4% 6 months since. So if you had just bought when this triggered on March, pretty much the 1st of April, you'd be up 4.4% right now. And at the highs, 8.4%. So we just triggered right now, and these are the results we can expect after 12 months on average. But thank you guys. Thank you so much for watching this video. If you like it, please give me a like, leave a comment guys, share this video, subscribe. You know I love you guys.